Today we're going to talk about Harmoney ASX HMY. This company is all about providing personal loans to people from Australia and New Zealand. And a fun fact about this company is the fact that these guys are the largest online direct lender for Australia and New Zealand, so they're pretty big. It's a company founded in New Zealand, but now it's listed on the ASX and they IPO'd back in November 2019. Hey guys, my name is Fyzee and this channel is about finance and investing. Before we begin, this video is not financial advice. I'm not a financial advisor. We're speaking in a very general sense only. Please do your own research before we begin. In this video, we're going to look at the company's share price, some recent announcements, what the company does, its financials, and my personal opinion on the stock. Let's get into it. So starting off with the company's share price, we can see that they IPO'd back in late November at a share price of roughly around $3.50, and we can see that mostly from there onwards, the share price has been on a decline, and since the IPO, the share has basically lost around 43% of its value in just around 5 to 6 months. Now, as you guys can see, the share price didn't go straight down. There were a few bumps along the way, and there were a few price spikes around that Christmas time of 2020, and then again a month later in January, around that mid to late January mark. Now, these two spikes relate to two significant announcements that the company did, which we're going to get into in the next segment of this video. But even after that, we can see that the share price has declined onwards and the sell-off has continued, and now the stock is trading for just around that $2 mark, as you guys can see based on the graph. So let's have a look at some recent announcements for the company. So on the 22nd of December, we can see that the company secured a $200 million funding in debt from M&G Investments, which is for 3 years initially. Now, M&G Investments is a global asset management firm headquartered in London, and this will be Harmoney's third debt warehousing facility. Now, why this news is significant is the fact that back in 2018, Harmoney made the call to stop funding their loans from peer-to-peer retail investors and start funding from their warehousing options, and progressively over time switch to this warehouse funding model. This means that Harmoney will no longer take money from retail investors and lend it out to borrowers. Instead, they will take money from the warehouse facility and lend those funds out to borrowers instead. In fact, guys, even if you check their website at the moment, you can see that they indicated on April 2020 that they've stopped doing this. So why make the switch? Well, because through this method, they're going to be much more profitable, and having a global firm like M&G behind them further validates their offering and gives more confidence to investors, as we saw with the share price jump, at least in the short term anyways. So right now, 42% of their loan book is through warehouse financing, but over time we should start to see the peer-to-peer lending segment start to decrease progressively. And on the 20th of January, they made another announcement which talked about the loan origination forecast exceeding, which prompted the share price up, as we saw earlier. And the company is gaining fast traction in the Aussie market, much faster than the NZ market, and that's to be expected because there's a much bigger population here and there's much more demand for those services as well. And overall, Harmoney has generated $1.9 billion in originations for their loans, which is just massive. And on the 12th of April, they surpassed $2 billion in New Zealand loan originations, which is again a huge achievement for the company. So let's have a look at a quick overview of the company. Having a look at some high-level metrics and a rough timeline for the company listed back in November 2020, and they received around $57 million in the net proceeds of the IPO. Then they secured up to $200 million in funding from M&G, which we just spoke about. And then in January 2021, they exceeded the prospected origination forecasts. And then in February 21, they released Libra 1.7, which we'll talk about in just a second. And then they appointed a new independent director in Australia. Looking at some high-level results as well, we can see some decent numbers coming out as well. But one thing that stood out to me was the fact that they have a 11% net interest margin, which is quite high. And this margin is basically the spread between the money that they lend out versus how much it costs them to lend out the money, and they make the spread in between. So basically, Libra 1.7 is the new update to their software, which allows Harmoney to automate some of their processes when it comes to decisioning loans and pricing loans as well, based on the risk factors of the customer. And essentially, they've been able to look at some past data from applications to map out some key behavioral characteristics so they can predict the credit risk of a customer, and we can see some good numbers coming out as well when it comes to actual conversions. Now, looking at the origination growth for the company, we can see some pretty insane numbers coming out. the KGR is an impressive 79%, which is just crazy. In just around 6 years, they've been able to do this and reach originations of $2 billion. And these new updates to their systems will allow significant growth here in Australia as well. And looking specifically as to what type of things they're doing when it comes to technology, you can see that this is all powered by their proprietary software called Stellar that they've worked very hard to develop over 6 years, and as a result of this they've made some pretty significant progress when it comes to automation, where they've basically automated 62% of their loan offerings. And as mentioned before, these guys are basically using past data to make their decisions, and as of now they've looked at 1 million credit files, which is just insane if you think about it, and they've assessed over 420,000 applications, which resemble over $7 billion in applications. So basically you guys can see that over that 6-year span, they've got a wealth of data and information that they can really dig deep into and analyze to find trends and make their business better. Then they also have machine learning, where the algorithm learns and improves with every single application, and this all helps the customer experience remain positive and consistent, because at the moment they've got tens of thousands of positive reviews. And we can actually see all of this play out in the numbers. As you guys can see, in the second quarter of 2021, new loan originations grew by 207% in Australia, as shown by the blue on the far right, as you guys can see right here. And then they've also started to resume their marketing. So for this company to keep on growing, penetrating the Australian market even more is a huge factor for them. Now guys, one thing that I found super interesting was the fact that in this presentation they mentioned that they want to start attracting more and more millennials and the younger population, and their Libra 1.7 edition is going to help with that, no doubt. But as you guys can see, if we look at the customer composition, we can see that the bulk of it is mostly baby boomers and Gen X, and not so much millennials and Gen Z. Now I'm not too sure why this is the case, but personally if I was to go for a loan, I feel that competitors like MoneyMe and Fyzee are doing a much better job of capturing the younger generation, and for me that would be the best fit for me if one day I decided to get a personal loan. Because if you look at MoneyMe's and Fyzee's website, they seem to be doing a much better job in marketing to that population, and their website just looks pretty modern to me. But let me know what you guys think. And looking at this information, even if you look at the property ownership, 50% of the customers owned a mortgage already, and millennials and Gen Z are struggling quite a lot. So I feel as though even though they're trying to market to the Gen Z and millennial population, they don't seem to be doing a good job at that, and they seem to be struggling in that front. Now let's look at the financials for this company, but before we do, if you have found value so far, please leave a like and subscribe. It really does help out with the YouTube algorithm. Thanks guys. Let's have a look at the financials. Having a look at the income statement for this company, we can see that the interest income has gone from 7.7k to 15k, and this has basically doubled nearly at an increase of 95%, which is pretty impressive. And we saw that previously with the loan originations ramping up, so this basically reflects that. Looking at the expenses for this company, they've increased by roughly 7 million, but the overall loss has still gone down by about 4 million roughly, and that's largely driven by their revenue figures increasing quite substantially. And they've also turned down their marketing expenses during this period by 2 million, and that's largely due to the impacts of COVID, because they didn't want to keep on advertising during the COVID period. Having a quick look at the balance sheet as well, we can see a massive increase in the cash balance, and this has basically doubled, as you guys can see, and that's due to a few reasons, as we'll have a look at later on. Mostly due to the IPO, which gave a huge cash injection into the business, and we'll go into that in just a second. But it's good to see the finance receivables increasing from 129 to 199 as they start to write more loans, and this figure actually already includes an expected loss provision, which basically means that they've estimated how many customers won't be able to pay back the loan, and they've already added this figure into this estimate. So this is a conservative figure that we're looking at, and despite that, this figure has still grown. Looking at liabilities, we can see that they've increased their borrowings by quite a lot, and that's to keep on borrowing money to lend out to customers so they can write more loans. Looking at the cash flow statement for the company, we can see that the interest received reflects what we spoke about previously, and the main cash inflow in the business is from the share issuance, which we spoke about early, with the net cash injection being around that $57 million mark. Now for a business like this that's making a loss, they do need to have a solid cash balance available, and we can see in this cash flow statement that they have around $78 million of cash just sitting there. So this should hopefully be enough to last them for the next few reporting periods. But once again, with companies like this which are making a loss, you really want to do your own research on this and look into it much more in depth, because you want to be confident in your purchase if you do decide to buy this company. Now, my thoughts on the company are that I do like the fact that they're such a massive lender and they do have a backlog of all these applications and so much data which they can use and analyze and find trends. But when I look at this company from a customer standpoint and as someone who's part of Gen Z, if I ever wanted a loan, I would not choose these guys at all for a few reasons. Firstly, if you look at their website, it does not look modern at all, and it doesn't look appealing to someone who's part of the younger generation. And I'm making this comparison when looking at Fyzee and MoneyMe's websites, and they both look pretty modern and appealing. Now guys, this may just be a personal preference, but do let me know your thoughts on this. And secondly, all three companies are pretty similar in the sense that they do wish to lend money based on the customer's credit rating, but Fyzee and MoneyMe seem to have a bigger value proposition for the customers. Fyzee lets you see your credit score and helps you pay down debt with their technology, and MoneyMe has a lot of other products as well, not just a personal loan. But if you guys have a look at their website, for Harmony, it just seems that they just offer a personal loan and nothing else. And if you look at all of these points, these 3 points are basically offered by all three lenders, Fyzee, MoneyMe, and Harmony. So I can't really see a moat or some sort of a differentiating factor other than the fact that Harmony is quite a big lender. Plus, the average interest rate for a loan with Harmony is 17.4%, which is pretty high compared to Fyzee or MoneyMe. And I feel like if customers have a good credit rating, they might want to choose those two options instead, rather than going through Harmony. And I think financially, those customers could be better off going with those other two options, but these are just my thoughts anyways. But all of this is not to say that the company cannot succeed. I'm not saying that at all. After all, they are the biggest. They've been in the business internationally as well with New Zealand, and we've seen some pretty impressive figures as well. But personally for me, I haven't invested in the company at all right now, and I don't plan to invest at the moment, but I'll keep watching them just like I'm watching Fyzee and MoneyMe at the moment. These two companies are also doing some pretty interesting things in the fintech space, so these two videos will help out with your research as well. And guys, thanks for watching. Please like and subscribe, and I'll see you in the next one. Bye now. Now, as you guys can see, the share price didn't go. Now, as you guys can see, the